What's going on, guys? Jake Claver here, and today I want to talk to you about where DeFi has to go if we're ever going to get real institutional adoption. Not hype, not anonymous wallets, chasing yield, not another casino built around speculative APY, real infrastructure. The kind of infrastructure that family offices, institutions, funds, RIAs, banks, broker-dealers, and serious capital would actually use. And the big issue is this: DeFi does not need to be destroyed by regulation, but DeFi cannot scale if there is no responsible party involved. And that's the tension. One side says it's decentralized, leave it alone. No oversight, no controls, no identity, no accountability. And the other side says it's too risky, shut it down and force everyone back into the legacy system. I think both sides are missing the real answer. The answer is not to kill DeFi, but the answer is to regulate the risk layer properly, especially when we're talking about liquidity pools. And that's what we're going to get into today, and why the XRPL is going to be the winner when it comes to DeFi. All right, so let's talk about liquidity pools as far as DeFi goes. A liquidity pool is not just code. It's a pool of assets. It has participants, it has fees, it has pricing, and it has real financial risk. The risk can show up in smart contract risk, liquidity risk, market risk, and even counterparty risk. And if real capital is going to move into these pools, then somebody has to be responsible for it. And that's the key. Somebody has to be accountable. And no, it cannot be a DAO. It cannot just be the GitHub repository. It cannot be some pseudonym or anonymous founder, and it can't just be a front-end interface that says use at your own risk, which is what a lot of them are today. That might work in experimental crypto and for the people that are native, but it does not work for institutional capital. It does not work for family office capital. It doesn't work for retirement assets, or for banks or broker dealers or insurance companies or corporate treasury companies. Anybody that's managing real money and is a fiduciary, not going to touch this stuff until it's regulated. So if DeFi is going to become part of the real financial infrastructure that we all want it to be, liquidity pools need a regulated structure around them. So what does that structure even look like? Well, a liquidity pool, let's say it has digital commodities, then it should work within a proper commodities framework. That means those involved should be working with the CFTC as a registered commodity pool operator, a commodity trading advisor, an introducing broker, or another properly registered entity, depending on how these end up getting structured. And there'll probably be multiple parties like that are the broker or those that have oversight in these liquidity pools. If liquidity pools, let's say they involve securities, tokenized securities, investment contracts, or security-like products, then probably would end up on the security side of the house. They would need a broker-dealer, an ATS, probably a qualified custodian, and the right private placement memorandums and suitability framework so that people know what the risks are when they're participating. So the point is simple. Commodity pools should not pretend that they are not commodity pools, and security pools should not pretend they are not security pools. And DeFi should not pretend risk just disappear because execution happens on chain. In fact, because DeFi is transparent and programmable, we should be able to better regulate this model than the one we have today. The model where liquidity pools are not black boxes, but a model where participants have credentials, a model where risk parameters are enforced automatically, and a model where disclosures are tied to real-time data. And most importantly, a model where there's a responsible party with authority inside the pool. So let's talk about the elephant in the room, the one that nobody wants to talk about, and that is that a serious liquidity pool needs an accountable operator. It needs someone underwriting the risk, reviewing the assets, approving the strategy, and monitoring the pool in real time. It needs someone making sure that the pool is not being manipulated and that only the right people, entities, and agents, because we know we're moving into an agentic economy, can access it. And it needs someone with authority to be able to step in when something doesn't go right. Because if no one has authority, nobody is accountable or has responsibility. And if no one has responsibility, institutions, they're not going to participate. So this is the real reason institutional capital hasn't really moved into DeFi at scale yet. It's because institutions don't like making money. Believe me, they do. And it's not because they don't understand blockchain, because they're pretty well there on that too. It's because they cannot answer basic questions about DeFi. Who controls the pool? Who approves the strategy? Who verified the participants? Who handles things if things don't go right? And who is liable if there's something that's a misrepresentation? Until those questions are answered, serious capital is going to stay on the sidelines. So this is my view. The next generation of DeFi will not be anonymous, free for all, yield farming, crazy things. The next generation of DeFi will be regulated, credentialed liquidity networks. And it's going to have all the fun stuff that you guys know, like, and love. OFAC, BIS, KYB, KYC. You need to know who's participating in these pools. And that brings us to digital identity. In the future, if you're participating in a serious liquidity pool, you will not just be able to connect a random wallet and start moving money. There will have to be a digital identity layer. And that layer here will need to support KYC, KYB, and the new one, KYA, Know Your Agent. KYC means you know who the individual is. Are they verified? Are they allowed to participate? Are they accredited, or are they a qualified investor? And are they in the right jurisdiction? Same thing goes for a business. Who's the beneficial owner? Is it a fund, trust? Is it a family office? Is it a regulated institution? Who owns it? Who controls it? And who has the authority to act on its behalf? And we know T54 is working on the digital identity for agents, and Ripple's made an investment there, which we'll talk about later. So let's get into why Know Your Agent would matter. Well, this is going to become incredibly important because the future of finance is not just humans clicking buttons. The future of finance is agents, AI agents, trading agents, treasury agents, compliance agents, automated systems acting on behalf of individuals, businesses, funds, and institutions that go out and do things in a guardrailed way. So the question becomes, who is the agent? Who authorized it? Who allowed it to do what it's doing? And who is the ultimate responsible party for its actions? And you have to be able to ask, can it trade? Can it borrow? Can it withdraw? Can it access leverage? Can it even enter securities pools or commodity pools? All these things are still up in the air because this is so new. And these permissions need to be defined before an agent can ever touch one of these pools. And I think that may be part of the reason the regulation has been delayed so far is this hasn't matured yet, and they really don't understand the parameters around this, and it definitely needs to be in there for DeFi to operate at scale. Because once capital markets become programmable, the participants are not only going to be people, they're going to be people, businesses, and the agents that act on their behalf. And if we don't know who the agent is that's entering the system, then we're going to have autonomous software moving capital through financial markets with unclear authority, accountability, and risk limits. That cannot work at an institutional scale. So the next piece of this is, okay, we know who the person is, we know who's accountable. Do they have the credentials to even be able to access this stuff? When we pull it all together, the future model is not just identity, it is credentialed financial access. A participant should not simply have a wallet. They should have credentials attached to their digital identity. A person can have credentials, a business would have credentials, an agent would have credentials, and a wallet itself could carry credentials. And a pool should require guardrails and parameters around those to participate in. And one pool may only be available to accredited investors, similar to how private funds work today. Another may only be available to qualified purchasers, or APs, which are, you're managing $100 million or more. Another may only allow regulated institutions, and others may only allow agents to participate with limited permission. This is not anti-DeFi. This is how DeFi becomes implemented at scale with regulated financial institutions. Not every pool should be accessible by every single wallet. A retail participant should not be automatically allowed to participate in the same pool as a qualified purchaser. A US person should not be automatically allowed to participate in the same pool as a non-US person. And an agent should not automatically be able to have the same authority as a person or an entity that it represents. Different pools will have different risk, different participants will need different credentials, and different agents will need different permissions. And this is where responsible DeFi is going. Okay, so now we know who can participate, what's required for them to participate, but there's still that authority in the pool. So what is that person even doing? Well, they're going to be underwriting the risk. If a CFTC registered firm, broker-dealer, or another regulated intermediary is involved in a liquidity pool, and they should not just be somebody that says we have regulated partners, they should be actively underwriting the risk in the pool. They should understand what is inside the pool, how the strategy works, and what liquidity profile even looks like, or what might happen if there's stress in that system. They should understand the major failure points, including, smart contract exploits, an oracle failure, a liquidity crisis, or a governance attack. And that is what responsible underwriting looks like. And if they're going to underwrite the risk, they also need oversight and authority. They need the ability to enforce the rule, pause the pool if there's an emergency, or even block non-compliant wallets and remove unauthorized agents if they don't have the right permissions or guide rails set to participate. Again, this does not mean destroying decentralization, okay? It means putting accountability where financial risk actually exists and understanding what those are if you're going to participate in DeFi. So what does regulated DeFi look like? Is there a bridge? Is it something completely separate? Well, I think the best version of this is not a TradFi replacement, okay? It's DeFi absorbing the best parts of a regulated market structure, the transparency, the disclosures, identity, suitability, standard around custody, and responsible intermediaries. And then you combine that with DeFi and what it does better, which is instant settlement, programmable rules, on-chain transparency, automated execution, and access to global liquidity. That is the bridge. It's not TradFi versus DeFi, it's regulated DeFi, compliant liquidity, programmable capital markets. Now, some people hear this and they're gonna say, Jake, that sounds centralized. I would say I disagree. There is a difference between centralized control and accountable oversight. A pool can still settle on chain, it can still use decentralized infrastructure, and it can still have transparent smart contracts. But if the pool is taking on real financial risk, there needs to be someone that's held accountable if something goes wrong. And I don't view that as a weakness. I view that as this market maturing. So I'm going to give you guys my 7-part framework here. If I were designing the ideal liquidity pool framework for the next phase of DeFi, it would have 7 things. Number 1, it would have legal classification. It would define what the pool actually is before it even launches. 2, it would have the right regulated intermediaries. It would involve the CFTC if there's commodities. If it involves securities, then obviously there's a broker-dealer, and the SEC may have some oversight, and it's going to use proper security frameworks. Number 3, there's a responsible party with authority, someone that has to underwrite the pool, monitor it, enforce the rules, and be accountable. Number 4, it would have digital identity and credentials in order to be able to access the pool. KYC, KYB, KYA, all of the above. Number 5, it would have transparent risk disclosures. Participants need to understand the risks that they are entering before they put their money into this pool or their assets into the pool, whichever it may be. Number 6, I think you need on-chain proof and off-chain accountability. Okay, so on-chain data gives transparency, but the off-chain responsibility gives enforceability. And I think you need both. And last but not least, number 7, you need emergency protocols. They have limit down in the stock market for a reason. They need to have predetermined rules for what happens if there is a smart contract exploit or a liquidity crisis or somebody pulls too much money out. You need to have ways to be able to regulate that, and there needs to be emergency controls. You also need to understand if they could pause the pool if there's a situation. How do you block a malicious actor? Can you remove a compromised agent? And who notifies all the participants of the pool when these things happen? If those answers are not clear before there's a crisis, they're not magically going to become clear during the crisis. These are all things that institutions want in place before they're going to enter this type of stuff. And we see the mountains of capital and liquidity move in that a lot of retail investors or family offices would want to see. So let's talk about the evolution of this market. This is where I think DeFi is going, and it's a major evolution. The first version of DeFi was about open access. The next version of DeFi is going to be about trusted access. Not closed off access, but trusted access, credentialed access, compliant access, access based on who you are, what entity you represent, what agent is acting for you, and what risk you are qualified to take. That's the unlock, because the real opportunity is not just building another liquidity pool. The real opportunity is building a framework that allows trillions or quadrillions of dollars to move safely, entering these programmable markets. And the winners in the next cycle are not going to be the people who avoid regulation for forever. The winners are going to be people who turn regulation into infrastructure. Identity becomes infrastructure. Compliance becomes part of the infrastructure. Credentials are added to the infrastructure, and the risk and the underwriting become part of everything that's involved here, including, parameters around digital agents that are also involved in participating in these pools. And liquidity pools become the programmable backend for global finance. Let's get to the part you guys came for, which is why XRP and the XRPL matter in all of this. Because of all the reasons I just mentioned, I believe that DeFi on the XRPL is going to matter more than almost any other network, because the future of DeFi is not just about who creates the highest APY or yield or returns in these pools. That was just the first inning of DeFi. The next is about compliant liquidity. It's about institutional grade settlement, identity, responsible pools, tokenized assets, regulated access, and real capital moving through programmable infrastructure with speed, transparency, and accountability. And that's where the XRPL excels and is uniquely positioned to capture this market. The XRPL was not built as some meme coin or as a casino. It was built for payments. It was built for settlement. And it was built for moving value. It was built to be fast, efficient, scalable, and reliable. It's never been down in the entire history of the blockchain. And if you understand where financial markets are going, all of that matters, because DeFi does not win long-term by being the Wild West. DeFi wins long-term by becoming trusted piece of the infrastructure. And the XRPL already has the bones for all of that. They've built all of this with the amendments over the past couple years. It has instant settlement. It has a decentralized exchange built into the protocol. It has fast finality. It has low transaction cost. And XRP, well, you guys know it, is the native bridge asset. And that's the key. If the future is tokenized assets, regulated pools, digital identity, stable coins, real world assets, and institutional liquidity, then there has to be a neutral settlement asset that can move value between all of those markets. That's what XRP was designed for, alongside being premium collateral. We'll get to that in another video. So when I talk about regulated DeFi, I'm not talking about DeFi disappearing. I'm talking about DeFi graduating or maturing to the level where it can be used by financial institutions. And I believe the XRPL is the most logical place place for that graduation to happen, because it already has digital identity, credentials, permission domains, permission DEX, all of the other things I just mentioned. And Ripple has been championing this blockchain and integrating it with financial institutions and buying or acquiring all the companies required to actually make this scalable and for everybody else to use it. It's not any other blockchain out there that has a regulated asset that has all of those other components as well. So we'll see how things play out, but that's my 2 cents. So in closing, first era of DeFi was anonymous yield. The next era of DeFi is going to be regulated liquidity, and the XRP ledger was built for that world. So my message is simple. Do not ban DeFi. Do not over-regulate it into the ground, but also don't pretend that anonymous pools of capital with no responsible party are ready for institutional scale. We have to build the wrapper, define the pool, create credentialed participants, verify the businesses, know the agents that are going to be participating in this new world, monitor the transactions, underwrite the risk, and give a responsible party oversight in DeFi. And with that, DeFi will mature into what it's always supposed to have been: a faster, more transparent, more programmable version of financial infrastructure. That's the future that I see. And the people who understand it now are going to be the ones who are participating in those rails or building those rails for everybody else later. So let me know what you think in the comments below. And I have to give my disclaimer: nothing here is financial advice. It's only for entertainment and educational purposes. You should always speak with a financial advisor before making any financial decisions. And these opinions are my opinions. They are not the opinions of Digital Ascension Group or any of its subsidiaries. Let me know what you think in the comments below. Like, subscribe, hype, and tell me what you want to see in the Clarity Act. Is it what I gave you here, or is it open, decentralized infrastructure, or should we just shut it all down? I want to know your opinions. But till then, stay blessed. Love you guys, and we'll see you on the next one.